You shall be able to learn about the financial markets, identify the various components of market infrastructure, evaluate linkage between financial markets and economic development, analyze the need for financial market regulations. A well-developed and regulated financial market plays a vital role in improving the efficiency and the health of an economy. There exists a strong positive correlation between the development of financial market and economy. Various studies at firm level, industry level and cross-country level shows that the magnitude of the impact of financial development on economic growth is huge and diversified. A smooth functioning financial market ensures the efficient allocation of resources, flow of savings, for example, household savings, corporate savings, etc., and investment in the economy so that the maximum accumulation of capital and production of goods and services can be achieved. Increase in capital accumulation and production of goods and services are some of the major indicators of economic development. To understand this relationship, we first need to know the financial markets, how it functions smoothly, and the ways in which economy is benefited with the development in this sector. Next, we will discuss about need for financial market regulations and some institutions which govern, direct and regulate the financial markets of their respective economies. Financial market. In simple words, financial market can be viewed as a channel for allocating savings to investment. Financial markets provide a wide array of instruments through which a lender having idle savings channelizes his savings to the others who have urgent need of funds. Stocks, bonds like corporate, government, etc., commercial papers, treasury bills, exchange traded funds, mutual funds, pension funds, insurance schemes, mortgage-backed securities, derivatives, fixed deposits, bank deposits, provident funds are some of the popular examples that belong to the vast array of financial instruments. The existence of a variety of options enables the investors to raise funds using options which meet his requirement the most. Along with providing a variety of options, a well-functioning and developed financial market saves the time and cost of borrower while searching a suitable lender. The lender of the funds is also benefited with the existence of financial markets. The risk of default on the loan advanced gets reduced as a financial market pools the savings from a number of small investors and extend these out again to a number of borrowers. By doing so, financial market diversifies the risk of default and lender enjoys the reduced risk. The next is importance of financial markets. A well-functioning financial market ensures financial stability and the effective transmission of monetary policies. Financial market serves as the starting point of infusion of monetary policies in the economy to alter liquidity level. An underdeveloped financial market may scatter the effectiveness of monetary policies with adverse effects on real economy. Financial stability implies deep liquid markets which ensures diminished liquidity risk of banks, risk which is natural in banking sector. The pliancy and proper functioning of market infrastructure is of dominant importance to ensure well-functioning, smooth operation of money market. High level of security and efficiency in allocation of resources, both the attributes of a smooth operating financial market, are of paramount obligation of the central bank as well as of the government. Public authorities and central bank in developing markets continuously strive to enhance this level. The market infrastructure includes the financial intermediaries like banks, insurance companies, credit unions, investment trusts, etc., regulatory authorities like SEBI, payment systems, central securities depositories, central counterparties, securities settlement system, and trade repositories. The development in these infrastructures ensures reduced risk, enhanced liquidity, availability of funds, wide array of options available to lend or borrow, etc. Reforms in financial markets. Since the financial turmoil of US economy in 2008, starting with the bankruptcy of Lehman Brothers, one of the largest investment bank in the world, its adverse effect on world economy, several steps have been taken to reform the financial markets. Strengthening of regulatory bodies, development of market infrastructure, improved transparency, and diminished counterparty risk are to name a few among several reforms introduced worldwide. Before proceeding further in this segment, let us discuss two key terms, counterparty risk and multilateral netting. Counterparty risk. A counterparty risk is the risk to each party involved in a financial transaction. Counterparty risk can also be viewed as default risk that the other party will not fulfill his contractual obligation. For example, two individuals, say X and Y, enter into a financial contract where X agrees to lend a specific sum money to Y at the beginning of each month for a year starting from today, and Y will pay back the amount to X after a year with R% of interest on it. Here X is counterparty to Y and Y is counterparty to X. Both the parties are exposed to a risk that either of them may not fulfill his obligation. Y has a risk that X may not lend all the money which he promised, while X has a risk that Y may not lend his money with interest on time. Multilateral netting. A multilateral netting is an arrangement among multiple parties that the transactions will be summed up while settling them individually. The arrangement thus streamlines the settlement process and reduces risk. The risk is reduced because the arrangement specifies that in case of a default or any other termination case, all outstanding contracts will be likewise terminated. Entity like an exchange enables multilateral netting. A number of ongoing investigations into manipulations of key money market reference rates are the main drivers of recent development in the functioning of money markets. In India, SEBI, that is Securities and Exchange Board of India, keeps an eye on this development and is responsible for the reforms in reference rates. The next is role of central counterparties in financial market development. In the process of financial market development, central counterparties, which are also known as CCPs, have emerged as a crucial institution. The CCPs play a vital role in mitigating the potential risk among the counterparties associated with a financial transaction. The role of a CCP, for example, stock exchange, becomes inevitable while trading in futures contract or when the markets are volatile. CCPs act like clearing houses of the future contracts where all the members of an exchange are required to clear their trades and settle the transactions at the end of each session. The members are asked to keep a minimum sum of money, often known as margin, which is sufficient enough to cover the member's debit balance. If a member fails to keep the minimum margin with the clearing house, his transaction is immediately foreclosed. For example, if a member broker buys 100 baskets of shares of rupees 1000 per basket on a particular day and sells out only 50 baskets, then he would be net long 50 baskets at the end of the day. Let us assume that net long of 50 baskets is his only position in the futures and the clearing house margin requirement is 10% per basket. Then the broker would be required to have rupees 5000, which is 10% of 50 into 1000 on deposit with the clearing house. Failing to maintain the margin would automatically result into the settlement of his contract by debiting his account with the amount equivalent to the price of the baskets with which he has a long position. The CCPs thus mitigate the risk of default of the counterparties and it enhances the transparency of trade, which in turn helps in better risk management and reduces the excessive leverage. The CCPs use multilateral netting to settle a contract and free up collaterals. The next topic which we are going to cover now is financial markets and economic development. There exists a bilateral relationship between financial market development and economic development. As the economy develops, the availability of funds to be invested increases and the cost of borrowing also decreases. The credit seeker enjoys reduced cost of borrowing, which maximize or incentivize them to borrow money. This in turn increases the level of investment in the economy and drives the development wheels faster. The development in the financial market is not limited to cheaper availability of funds to the seekers, but it spans a wide range of benefits to the borrowers as well as to the lenders. Financial market development ensures liquidity in the economy by providing ready market to the investors and credit seekers. Also, a well-developed financial market offers an opportunity to the investors to convert their long-term investment into short-term and medium-term investment. There exist a number of financial intermediaries in a well-developed financial markets which offers an array of investments and borrowings options to the customers. Mutual funds, pension fund schemes, insurance, financial advisories are some of the widely used services of the financial markets. Financial markets serve as a channel for the process of disinvestment and investment. On a stock exchange, securities of various public sector and private sector companies are traded and the advancement in technology used in the process of trading made it possible to keep a track of the real-time prices of the securities. This helps the investors to pick the most productive investment proposal. The investment in most productive investment proposal leads to a capital formation and thus an economic growth. Development in financial market promotes savings and investment habits of the citizens of the respective economy. By offering a number of attractive schemes and securities, a financial market encourages people to save and invest more in productive options rather than investing in unproductive assets like in gold, silver or else. Also, a stock exchange can be seen as a reliable economic barometer of an economy to measure its economic condition. A change in the value of the stock exchange implies a change in the level of investment in the economy. A bull's market, that is rising market, indicates that the level of investment through FIIs and FDIs has increased, whereas a bear market, that is a falling market, indicates that the level of investment has decreased in the economy. The next topic is need for financial market regulations. Since the economic development of an economy is directly linked with the development of financial market, the effectiveness of monetary policies largely depend on the performance of financial market. Government has an obligation to regulate and supervise the activities taking place in the financial market. To serve the best interest of the citizens and the economy, the government thus issues some guidelines to regulate financial market transactions to mitigate malpractices. The government may constitute a constitutional entity or a non-government entity to execute guidelines, take actions against violators, and supervise the entire financial market of the economy. A well-regulated financial market increases the level of confidence among the investors and also insures them against the potential risk. Various economies have instituted an independent non-government entities to serve the function. These entities have been very impressive to fulfill their expectations and also stabilize the financial market. Summary. Let us now summarize what we have learned in this module. A well-developed and regulated financial market plays a vital role in improving the efficiency and the health of an economy. There exists a strong positive correlation between the development of financial market and economy. Financial markets serve as a channel for allocating savings to investment. Financial markets provide a wide array of instruments through which a lender having idle savings channelizes his savings to others who have urgent need of funds. Stocks, bonds, commercial papers, treasury bills, exchange traded funds, mutual funds, pension funds, insurance schemes are some of the popular examples of financial instruments. A well-functioning financial market also ensures financial stability and the effective transmission of the monetary policies. The market infrastructure includes the financial intermediaries, regulatory authorities, central security depositories, payment systems, central counterparties, securities settlement systems, and trade repositories. Financial market reforms include strengthening of regulatory bodies, development of market infrastructure, improved transparency, diminished counterparty risk, etc. A counterparty risk is the risk to which each party involved in the financial transaction. A multilateral netting is an arrangement among multiple parties that the transactions will be summed up while settling them individually. The CCPs play a vital role in mitigating the potential risk among counterparties which are associated with a financial transactions. CCPs act like clearing houses of the futures contracts. There exists a bilateral relationship between financial market development and economic development. Financial intermediaries offer an array of investment and borrowing options to the customers. Development in financial market promotes savings and investment habits of the citizens of the respective economy. Stock exchange can be seen as a reliable economic barometer of an economy to measure its economic conditions. Infusion and effectiveness of monetary policies is greatly affected by the performance of financial market. Government has an obligation to regulate and supervise the activities which are taking place in the financial markets. A well-regulated financial market increases the level of confidence among the investors and also ensures them against the potential risk.